please welcome our CEO and Chief Investment Officer, my husband, Lou Altfest, who I've known more than 34 years. And in case anybody thinks that's not true, we have a bench in Carl Schurz Park to prove it.
So let me talk just for a few minutes about there are two sayings, two alternatives in the investment realm. The world is changing. The more things change, the more they remain the same. In investments, which alternative is true? Let's consider the investment world is changing alternative first. Computer and scientific methodology is making it more useful to backtest and utilize machine-generated information, which we can call quantitative analysis. Some of you who've come over to me tonight, and more of you are going to see this when you see your analysis, we'll see that we have had an upturn in buys and sells, a large upturn, particularly in the Altfest active stock portfolio. Those of you who don't know what that is or haven't been exposed to it, you're going to be exposed to it. You're going to be invited to become a person and that who invests in that, and it's we're investing in that and selecting stocks ourselves. So let me elaborate on the first alternative. We have taken, with things changing in the world, we have taken advantage of that to hire two individuals who blend quantitative analysis with our traditional fundamental analysis. Does anybody know what they're called? Close. They're called quantamental analysts. Quantamental, a legitimate term. With their help, we've been moving quickly to take advantage on the changing world developments. An example is a stock that we own that was cheap, major stock, and we had a position in, and the stock started to run. And their earnings didn't run, and through an analysis of both fundamentals and quantitative stuff, we decided that there was no fundamental reason for that stock to run. We sold it. The stock subsequently dropped, and we bought it back. So for the year to date, we're up 9% in that stock, and a passive investor who just did nothing was down 7%. So that's a 16% spread. Another example of what we're doing is we're investing in these newfangled quantitative funds. And we're doing it for a particular reason. The funds we have selected have downside protection. They give you some of the upside, but if the market gets hit, let's say down 20%, one fund in particular, you will get hurt to the tune of -5, and then you'll get a 15% ride, free ride, not affecting your security on the remaining, on the first 20% drop, 15 out of 20. So that's obviously new, and if markets decline, will be helpful in reducing risk, which is why we got into it at this point in time. Technological developments have already affected us in the sense that now buying securities at much cheaper, and we're going to be transferring our Altfest account, it appears, and we may get as much as a three-quarters, two-thirds drop in our expenses that we will pass along to you in the form of higher performance. This weekend, I took home some key statistics. The statistics on the entire S&P 500. Imagine the spreadsheets that I had with all kinds of factors. And we have a proprietary program that ranks all the securities by sector. And it was amazing. All these fundamental data and technical data and risk factors. And I was able to form tentative conclusions and check objectively on these funds and have conclusions by Monday morning. And that's one of the advantages of the world is changing and quantitative analysis. Let's consider the second alternative. The more things change, the more they remain the same. We have a core of value-oriented mutual funds and, to a lesser extent, individual stocks. Value managers, if you haven't heard this before, buy securities that are cheap and hold them until they're either fairly priced or even higher than fairly priced. Then we have partnerships, in a sense, with mutual fund managers who believe the same way we do about value, or they may have different definitions of value, but they're really value players. One of them is Dan Fuss, who you're going to meet in just a second. And throughout the ages, investors have overreacted and underreacted to new news. An example of that may be now technology, in which there have been a huge run on technology this year. Of the 10 best performing securities, a majority of them are technology securities, and they account for almost half of the performance of the S&P 500. Can you imagine that? 10 stocks account for almost as much as the remaining 490. So in part, I don't think we're at that point, but in part, it's beginning to look a little bit like the 2000 situation with technology. So in sum, today we are employing our own version of a core and satellite strategy. Our satellite approach takes advantage, the satellite, that's the shorter term development, takes advantage of new, more aggressive, shorter term opportunities. Our core holdings continue to have, the longer term securities continue to have a logical value tilt. The approach will be adjusted over time, but we like what's happening. The value-oriented orientation, the core has invested in international to a greater extent than almost all other managers, and we're up 15% in our international securities to date. And the shorter term satellite has worked out well for us in 2016 and 17. So it pays to keep up with a changing world, but it's at least as important to take advantage of time-tested, logical, value-oriented principles. In other words, the investment world is changing, and the more it changes, the more it remains the same. Both are true and can be blended well in the investment realm.